So hi guys, this is SJ speaking, and in today's video, let's see about Operation Twist. So this is one of the monetary policy tools used by the central banks. So in order to recover the economy from recession, so from the GDP slowdown. So let's see what it is. So before going to the video, I'm personally teaching trading. So if you want to learn trading from me, you can contact me from the number which I have given in the scrolling on my video below. So I'm totally taking 7 courses, or if you are interested, you can enroll any one of the 7 courses. So now let's see what is Operation Twist. So Operation Twist is a quantitative non-conventional monetary policy tools used by the central banks in order to reduce the long-term bond yields. That is the long-term government bond yields. So see here. So this is the monetary policy tools. I've already posted a video regarding these tools. If you didn't watch it, you can watch this. So under the quantitative tools, a non-conventional category, you can find the Operation Twist here. So this is where it belongs to. So in India, the RBI uses it in order to reduce the long-term government bond yields. So if you do not know what is government bond yield, I've already, before watching this video, watched the video I have posted regarding the open market operations and also the bonds. So there are two videos, watch those and then come to this video. So even though I will explain here what is bond yield. So bond yield means it is the rate of investment on the bond. So how much returns you are getting by holding a bond? That is what the bond yield. Coupon rate means there is another term known as coupon rate. So this is the interest rate which is given by the bond issuer to you. So you are buying the bond. So how much rate of interest is the bond issuer giving you? That is known as coupon rate. And then comes the bond price. So price of the how much money you are purchasing the bond, that is known as the bond price. So usually if the bond price increases, the bond yield comes down. If the bond price goes down, the bond yield comes high. So suppose if you are buying it directly from the issuer means, then the bond price is equal to face value. Okay, so then the coupon rate is also equal to the bond yield. But when you are buying at the secondary market, the bond price would be higher or low compared to the interest rates. Current interest rates, the bond would be higher or low. Interest rate means the repo rate. So the repo rate is directly proportional to the bond yield. So if the repo rate increases, then the demand for the bond comes down, and so the demand for the existing bonds comes down, and so the bond price reduces, and your bond yield would be higher. Similarly, if the repo rate reduces means that the demand for the existing bonds will become higher. So sorry, the demand for the older bonds. So older bonds becomes higher. Once the demand for the bonds becomes higher means then the bond price also increases, and then the bond yield comes down. So the bond price is inversely proportional to the bond yield, and repo rate is directly proportional to the bond yield. Take a note into that. If you do not understand what I am saying, you can watch that previous video. So this is the fact. And Operation Twist involves simultaneous purchase of long-term government securities and selling of short-term government securities by the central bank. In India, it is the Reserve Bank of India through open market operations. So there in open market operations, there is buy operations and there is sell operation. But here, the buy operation and sell operation takes place simultaneously. The long-term government securities are bought by the RBI from the banks, and the short-term government securities are sold by the RBI to the banks simultaneously. So this takes place. Usually the long-term government securities are the government securities which matures on 2026 and 2030. And then the when this Operation Twist was done, this was actually done in December 2019, and another Operation Twist was done in April 27, 2020. So the long-term government bonds which was maturing under 2026 and 2030, those were bought, and the short-term government securities which were to mature on 2020, those were sold to the banks. So what is the objective of this Operation Twist? The objective is that there was an economic slowdown. So in December 2019, during those, this was the first Operation Twist was performed on this period. So the economy was already in a slowdown. Slowdown means the negative growth in the GDP growth. There was a slowdown in the GDP growth. So GDP means goods and services, which are value of the goods and service produced. So the production was less. Why the production was less? Because there was no demand for the goods and services. Why there was no demand means there was no money in the hands of people. There was no income for the people. So there was less demand, and so the goods were need for the goods and services were less. That is why the goods and services were produced less. So the GDP was growing less, and further it reduced. So, if this continues further, if the GDP goes on decreasing, then the economy goes into a recession. So, in order to avoid the economy from going into a recession, the RBI RBI must perform the Operation Twist. Twist objective is to reduce the long-term government bond yields. Why? Because if the government bond yields are reduced, the lending rates for the households and firms will be reduced. If the lending rate for the households and firm reduce, for example, the firms, if the firms must get the loans from the banks in order to produce the goods and services, they need money for producing the goods and services. The money is they get the money from the banks. So if the loans are costlier, then the firms would avoid taking the loans from the banks, and so they would avoid producing goods. They would only produce less. So, in order to reduce the lending rates, if the lending rates are reduced, then the production would become higher, and then this would contribute to the GDP growth. So, in order to do this, the Operation Twist objective was to reduce the lending rate for the households as well as firms. Households too, many people would ask for housing loans, vehicle loans. If the lending rates are costlier, it would not be wise. They would not avoid getting the loans. So, in order to reduce the lending rates, this is the first objective. And second is the government, if the bond yields are so much higher, if the government needs to issue a new bond, the coupon rate must be higher than the existing bonds yield. Then why it will be attractive for the banks to buy the new bond. In order to contribute to the GDP, government also plays a role. So in the fiscal policy, government do some expenditures. So it does the expenditures for the economic development. Suppose if the government borrows money from the banks and use it for expenditures, so it might create a project, for example, building a highway or road or some other thing, or it might give it as subsidies to farmers or whatever it is. So employment opportunities are being created and income will be the hands of people. And once income comes in the hands of people, what will happen? The purchasing power will increase, demand for the products increase, and so the supply also will increase. The production will again increase, and so the GDP grows. GDP grows. So this is the growth in the economy. So in order to increase the money supply, the Operation Twist must reduce the lending rate for the households and firms as well as the government. The government must also lend it at a lower rate. So it will be easy for the government. So if the government needs to give a higher interest rate, it is very much difficult for the government. Uh, so that is why. So this is the objective of the Operation Twist. In order to reduce the lending rate for the households and firms as well as to reduce the borrowing rates for the government. I will explain it in detail later in the video. So let's see how this takes place. So December 2019, the first Operation Twist was performed. So our economy was in a slowdown. So that is the GDP growth was 7 and it reduced to 4.5 percentage. So it reduced. So there was negative growth in the GDP. There was fall in the GDP growth rate. So, what the RBI did, the RBI, in order to boost the economy, it reduced the repo rate to 135 basis points. That is 1.35 percentage. From 6.5 percentage, it was reduced to 5.15 percentage. So, once the repo rate got reduced, the RBI expected the banks to decrease their lending rates to the households and firms, but the banks only reduced to 49 basis points, that is 0.49 percentage. So still the loans were costlier for the firms and households. If the loans are costlier for the firms would not get the loans and the goods and services will not be produced more, which will not create more employment opportunities. So there will be no income in the for the households. So this is bad for the economy. So the RBI thought the banks gave a clarity why they didn't reduce the lending rates, because they were in an NPA crisis. NPA means non-performing assets. So the loans which they have already given, they did not receive the principal amount. So they were facing a liquidity shortage. So this is the clarity given by the banks to the RBI. There was also another thing. The repo rate usually is used as a benchmark for determining the lending rate to the households and firms, for determining the loan rates. So whether the loans are costly or cheaper depends upon the repo rate. But even when the repo rate reduced, they did not reduce. Why? Because the banks all were also following the India's 10-year government bond yield rate. Bond yield rate. So they were also following this 10-year government bond yield. So this they were also following this as a benchmark. So since the for suppose if the government bond yield is 8% means, take it for example. I do not exactly know what was at that time, but suppose take it as example for 8% means, what the banks usually do, they borrow it from the RBI and lend it to somewhere else at a higher rate, and the difference between that is their profit. So they pocket the difference between them. So this is what they do. If the government if the government bond yield itself, the rate of return on the government bond, 10-year government bond yield it itself is 8% means, the banks, if they lend it to the outside people, households or firms, whether it is riskier for them or lending it to the government is riskier for them. Of course, lending it to the public or the corporates is riskier for them. So the government bond yield itself is giving 8% for me. Why I should lend it to someone else who is having higher risk? So he might even default on its payment, but the government never defaults in its payment. So he might borrow it from the RBI at a lower rate, and he would invest in the government bond. So even if the bank wants to give loans to the households or firm, he would lend it at a higher rate, for example 10% or 11%, which is very much costlier for the firms and the households. So that is why what the RBI thought, we must reduce the government bond yield. So if the government bond yield is reduced, then eventually the lending rate would also be reduced, and also the repo rate is already been reduced. So the government thought, I must reduce the bond yield. So what the government did, before knowing about what the government did, let's know about a concept called yield curve. So yield curve. So yield curve means, let's take x-axis maturity, and this is the yield rate percentage in percentage. So 1 month, 3 month, 6 month, 1 year, 2 year, 5 year, 10 year. Okay. So this is the maturity periods. So this is the yield rate. Usually think about it. Suppose if you are lending money to someone for a short period of 1 month means, during the 1 month course, there is not that much would happen. So there is less risk. So you would lend it at a lower interest rate. But if you are lending money to someone for 10 years means, in 10 years many things can happen. So there is not guarantee that he will repay back the money. So there is higher risk involved. So you would charge a higher interest rate. So the short term maturity bonds will have a lower interest rates, and it will gradually increase, and the long term maturity bonds usually have a higher bond yield. So higher bond yield. The short term maturity bonds will have a lower bond yield, and the long term maturity bonds will have a higher bond yield. Usually with the yield curve will be a upper slope. So this is the normal yield curve. So this is the concept of the yield curve. Now let's see how the RBI performs this operation twist. So operation twist is performed by the RBI. So RBI sells the short term government bonds and gets, for example, it's selling about 10,000 crore means it's sucking out liquidity from the economy, from the banks, and with that money, it again what? It gives the 10,000 crore to the banks again. It gives it again to the bank 10,000 crore and purchases the long-term government bonds. Buys the long-term government bonds. So what it did, the RBI sells the. This is what is open market operations. It does both the sell operation and buy operation at the same time. So it sells the short-term government bonds worth of 10,000 crore and gets that money, and it again gives that liquidity to the banks and purchases the long-term government bonds from the banks. So what happens here? RBI is buying the long-term government bonds. So once there is buying, there is demand for the long-term government bonds. So if the demand increases, what happens? Demand for the long-term government bond increases. So the price of the long-term government bonds also increases. So what happens? The long-term government bond yield decreases. So bond price increases and the bond yield decreases. So because the bond price is always inversely proportional to the bond yield. And so this is what happens here. So similarly, in this case, what happens? there is supply for the short term bonds is increasing. Short term government bonds is increasing. There is not that much demand. So what happens? The bond price will fall down and the bond yield would increase. The bond yield of the short term government bond increases because the price of the short term government bonds is lesser. So this is what happening here. So what is the objective of the operation test? In order to reduce the long term government bond yield. So this objective is fulfilled here. So what happens? Usually the repo rate is also cut to 5.5. So this operation twist is done two times. One on December 2019, the repo rate was cut from 6.5 to 5.15. That is 135 basis point was cut. And again again the rate cut was around 75 basis points. So two times. So on April 27, 2020, there was another operation twist. The repo rate was already cut to around I think 210 basis points. 210, 135 plus 75. I thinking 210. I think so. 210 basis points was already cut in the repo rate, as well as the government bond yield was reduced by performing two operation twists, one on December 2019 and one on April 27, 2020. So two operation twist was performed, and the government bond yield was reduced, and the short-term government bond yield was increased. So this is what the twist, by reducing the long-term government bond yield and by increasing the short-term government bond yield. So what is happening once the government bond yield is reduced and further the repo rate is also reduced? Now what the banks must do? They must cut the lending rates. So the loans are cheaper for the households and firms. Once the loans are cheaper for the firms, then the firms would get the loans from the banks and they start to produce the goods and service at a higher rate, and so more employment opportunities are being created and more income would be in the hands of people and more purchasing power would be there and more demand for the goods and service will be there, which in turn will again increase the needs for producing the goods and service. So the supply must be there in order to cater the demands for the people, and so the value of the goods and service produced will be higher. The GDP is growing. So the economy is saved from going into a recession. It's prevented from going into a recession, and there is growth in the GDP. So this takes place. So again, if the government bond yield reduces, there is also another positive benefit. So if the government wants to borrow, so this is in one way the monetary policy is being done in order to increase the money supply. In order to boost the GDP, RBI does this thing. In another way, the government in fiscal policy, it needs to borrow money in it, and it also needs to increase the expenditures. In order to increase the expenditures, it needs to borrow money from the banks. The government needs to borrow money from the banks. Now, since the yield is lower, the long-term government bond yield is lower, if the government issues a new bond to the banks, it can issue a bond at a lower coupon rate. It can issue a bond at a less coupon rate. At a cheaper rate, it can borrow money from the banks. It can issue bond at a lower coupon rate. For example, if the bond yield is reduced, for example, I said 8%. If the bond yield is reduced to 6%, means it can issue a coupon rate at 6.25 or 6.5 at a cheaper rate, and it can borrow from the banks. So it is easier for the government. So this is also another benefit. So what I said, so these two objectives are achieved in this case of lowering the long-term bonds. There is also another benefit. Coming to this side, the short-term government bond side, what I said, the government bonds are maturing at 2020, the short-term government bonds. So once this bond matures, what happens? The government will give this money to this liquidity will be given to the banks. So who bought the short-term government bonds? So I already said the banks are in a liquidity shortage since there was NPA, so non-performing assets. Even the previous loans were not repaid. The banks were in liquidity shortage. But now, once these short-term government bonds matures, the liquidity will be in the hands of banks, and these banks will give it at a cheaper rate to the households and firms, as well as if the government issues a new bond also, it will give at a cheaper rate to the government also. So there is also liquidity pumped into the economy once this bond matures. This is another thing. So there are three benefits. The lending rates for the households and firms is also reduced. The borrowing rates for the government is also reduced. And therefore, after the short-term government bond matures, the liquidity is supplied to the banks. So banks have more liquidity. So these three things takes place. This liquidity is further given as loans to the public or the corporates at a cheaper rate. So once again, the GDP growth increases. So growth increases in the economy. So that is what the objective of the operation twist. So why the name operation twist came, because I will explain. So in the 1960s, the Federal Reserve, US Federal Reserve performed the Operation Twist, first Operation Twist in the 1960s. At that time, there was a dance known as Twist Dance, which was famous, and that is why this operation became to known as Operation Twist. And another reason is because I have said about this yield curve, so yield rate and maturity. So usually the short-term maturity bonds will be here, and the long-term maturity bond yield will be here. So by reducing the long-term government bond yield and by increasing the short-term bond yield, now the yield curve has been changed like this. So this is like a twist by reducing here this long-term government bond and by increasing the short-term government bond. So this is the twist which is done. So this is another reason for naming it as the operation twist. So hope you got a good clarification. So if you do not understand the relationship between the bond price and the bond yield, you can watch that previous video. And you do not know what is open market operations means, you can watch that previous video, open market operations, and then you can watch this operation twist video. So this is usually done in order to stop the negative growth on the GDP. In order to increase the money supply, this is being done. In order to prevent the economy from going into a recession, this operation twist is being done, and it's the simultaneous selling and purchase of the government securities by the RBI through open market operations. So it is done in order to mainly the objective is to reduce the long-term government bond yields. So hope you guys got a good clarification about what is operation twist. So if you enjoyed this video, give a thumbs up, share it with your friends and family, and give a subscribe to my channel, and also press the bell icon all button so you get notified for all my upcoming videos. And comment on my comment on my videos. It would be a feedback and motivation for me. Usually my Tamil channel is going, lot of views are going, but for my English channel, I don't know why the YouTube is not recommending my videos. So if you guys watch it fully, my videos would be worth it. So watch it, guys. So other than that, if you want to learn trading from me, you can contact me from the number which I have given on the scrolling on my video. So totally I'm taking 7 courses. Other than that, if you want to open a Demat account and trading account, so I have given you Zerodha link and Alice Blue link on all my YouTube videos descriptions. So you can refer to that link and start trading or investing by opening a Demat account from today onwards. So thank you guys. I'll visit you on my next video. Until then, bye bye. Take care.